Wow, Kyle and Samantha Busch claim they were scammed by Pacific Life Insurance Company and one of its agents out of millions of dollars. Yes, that Kyle Busch of NASCAR fame purchased millions of dollars of life insurance, sunk millions of dollars into life insurance, and in less than a decade had very little to show for it. In this video, we're going to dig into the details of what actually happened. We're going to address the scam. What went wrong? How did they actually get scammed? And then we're going to provide some consumer education, how to avoid this when buying cash value life insurance yourself. Welcome to Oregon Cash Flow Pro. My name is James Barber. We are always trying to educate people on this channel around life insurance. An optimally designed high cash value policy can be a beautiful thing, but a bad design, as we're about to go over, a poorly managed policy from a bad agent can spell disaster. We're going to hear from the Bushes here in just a moment. But one thing I want to make clear at the beginning, this is absolutely the case of an uneducated consumer coming up against a bad agent that didn't seem to be interested in doing what's best for their client. And this type of situation happens to uneducated consumers all the time in this country, just not at this scale. I liken this to an uneducated consumer going into a car dealership to buy a car. They don't know how to negotiate. They just know that the car that was presented to them looks good, it feels good, and they want it. And so they agree to a price above the sticker. They're paying MSRP and all of the dealer markups. And then they go into the finance office and they buy the extra warranty and the underbody coatings and anything else that they can add on to it. And they drive off the lot oblivious to how they just got ripped off. And they don't understand how the car works. They're not mechanics. And so a couple of years later, they go back to the same dealership for an oil change. And then the dealership says, oh, we've got to put a new engine in this car, but you're going to love it. It's going to drive so much better, just like the original car you thought you were going to buy. And they get fleeced again. And only after spending all of this money do they finally realize, wait a minute, what did we just do? It's an incredible story here. And it's just getting started because they just announced this lawsuit against Pacific Life 10 days ago. Let's hear what they have to say.
Here we are in New York City. Samantha and I are at one of the major news stations here in New York City. And as many of you may have seen, we have a press release out that we are in litigation with Pacific Life in regards to IUL policies and insurance policies that are also retirement policies for planning for our future. And unfortunately, ours did not go well.
Yeah, as you'll hear when this broadcast comes out, it was a major scam. We tried to do what we thought was best for our family, for Brexton and Lennox. We were trying to be financially responsible for them and plan for our future. And little did we know that by investing money in this scam, it's all gone. And so the reason we came out here today is, as you guys know, who've followed us for a while, every time God puts a struggle in our path, we are going to try to use it for good. And so we're out here speaking out about what happened because this just isn't happening to athletes and celebrities. This is happening to teachers, police officers, veterans. This is happening to widows. These are people who are 70 years old. They have nothing else to fall back on. These are people who are, they've worked hard. They've made a small business. They are ready to retire and they buy into these scams and they lose absolutely everything. And so, Kyle and I will use this platform to try to do all the good that we can. And so we're going to keep fighting Pacific Life and we're going to show the world that this was a huge and utter scam.
That's right. So tune in for further updates as we come along further in the case.
All right, so they posted that on X. Feel free to go follow along if you want to hear more from them as they report on it. I got a chance to read through the entire lawsuit. Pretty interesting. A lot of details were left out, but we've been filling in the gaps. I'm going to share that with you here today. But you can see right up here, this is from the lawsuit. In 2017, they were first approached by their agent, portraying himself as a wealth management and insurance specialist and retirement planner with direct access to Pacific Life's internal design and tax teams. He represented that he worked hand in hand with Pacific Life's home office professionals to develop exclusive retirement strategies for high net worth clients. This guy sounds like a slick salesperson. And there were some things that he didn't disclose. He has a criminal background that he didn't disclose when he got his insurance license. And so a lot of this stuff just came to light and feeds into the problem that these folks encountered. They came across a slick salesperson portraying themselves, puffing themselves up to be something that they're not, and utilizing structures that Pacific Life put in place in order to make massive commissions, as we're going to find out when we get into the details here. XLP Investor on X pulled this information from Bobby Samuelson's report. We're going to go through it as presented because there was a lot of details that were left out of the lawsuit that Bobby Samuelson was able to dig up. So let's read through what he put in the report, and we'll address it as we go through this. There are a lot of angles to the claims in the lawsuit. One is that the policies were positioned as investments that would deliver tax-free retirement income. That claim alone is problematic, particularly given that the language shows up in some of the emails that are included in the lawsuit, including from people at Pacific Life. Life insurance should never be referred to as an investment. It's an investment kind of like buying a home is an investment. It's not actually an investment. It's somewhere where you decided to put your money. And a lot of people refer to it as that, but insurance companies know better than to refer to life insurance as an investment. So I think that's why they're calling this problematic. Another angle is that the policies listed in the lawsuit are Pac Life's Discovery Accelerator and its successor, PDX2. Both of those products have been the subject of several other lawsuits over their inherent risk, complexity, and lack of transparency. Now, when I first saw that this had to do with those particular products, I recall that they had a bonus option that made it possible for you to pay extra money each year in order to get the opportunity to make a lot more money. Those bonuses could cost up to 7.5% each year, and you have no guarantee that you're actually going to make more money. That adds a massive expense to a policy without a guaranteed reward coming at the end of it. I thought that might be the case in here. Turns out they didn't even use that part of the product to accumulate the losses that they've experienced. This gets wild. Either of these angles could be reason alone to litigate, but neither of them individually or together can explain the astonishing loss of $8.5 million on $10.9 million of premium paid over just 7 years. Permanent life insurance is a simple product. Premiums go in, policy charges go out. Whatever is left over earns interest. Cash value is the balance of that equation. If the Bushes lost $8.5 million on a product with a 0% crediting floor, then there's only one explanation for how that could have happened. Therein lies the most problematic angle of all. The exorbitant agent compensation caused enormous policy charges that ultimately resulted in the losses. This case isn't really about life insurance in general, Index Universal Life in particular, or PDX or PDX2 specifically. It's about the unique way that Pacific Life has approached agent compensation for the last 40 years, and one agent who decided to push compensation to the absolute limit for his own benefit at the expense of policy performance. It's starting to sound like they absolutely did get scammed in a particular way by this agent. Pacific Life didn't do anything to stop it, and by virtue of how they did their communications, may have actually assisted. This is the allegations, and it's not looking too good on their part. But I do agree with the statement. This isn't really about life insurance in general. There are really good products out there. As you're going to find out here in just a little bit, there was a unique compensation structure that this agent was able to tweak and just make a mind-blowing amount of commission on this policy that you wouldn't be able to do in any other product. First, the basics. Both Samantha and Kyle Busch purchased PDX policies in 2018. Samantha's remained in force, but Kyle's was exchanged to a new PDX2 policy in 2022. In 2020, Kyle purchased 2 additional PDX2 policies, one with $44.5 million in death benefit and the other with $17.5 million. As a NASCAR champion with a long career ahead of him, Kyle was issued in 2020 as super preferred, but there was a $4.92 flat extra per thousand of face amount for 20 years, reflecting the inherent risk of professional racing. For the purposes of simplicity, I'm going to focus all the analysis on just the $44.5 million PDX2 policy issued in 2020. It is indicative of the design of all of the policies owned by the Bushes. This is going to be interesting because there's a couple of things that happened between 2020 and 2018 when they got their first policy, and now limits have changed when we're plugging in numbers. But we're going to find out here in just a second when he runs the numbers on a current product and what happens inside that product. I think the numbers are actually a lot worse on these older products. Okay, the policy was configured in a way that anyone who's familiar with Pacific Life policies would immediately recognize as being problematic. The premium commitment from Kyle for this policy was $1.5 million per year for 5 years. The person who wrote this report said they know 5-pay designs are prevalent in the industry, but he says they're inherently inefficient. I kind of agree, but kind of don't agree. It just depends on the underlying design of the policy. He says Section 7702A is set up to test on a 7-pay premium basis, which means that paying 7 years is almost always the most efficient way to maximally fund a policy. And that's true in relation to the underlying insurance expense. When you have a policy that the growth is dependent on the amount of money that you're putting in, there's a balance in there where if you get the money in over the course of 5 years with a proper design, you might only be paying a very small extra bit of expense, but you have 5 extra years to get extra growth and compounding. So while it's more efficient from an expense standpoint, it may not be the best type of design to go with 7-pay. But set that aside. It doesn't matter for this case. We know it wasn't an optimally designed policy. And in this particular case, a 5-pay is way worse than a 7-pay because of how this policy was designed. Now, there's a caveat that he lists here. We're not going to worry about that. He does say it would have been more efficient for this policy to have paid $1 million for 7 years and $500,000 for the 8th year while still retaining non-MEC status to ensure the lowest possible death benefit. This is true. Now, you don't know what the growth would have been during that time period, and it's possible the 5-pay could have turned out better depending on the growth earlier. But from an expense standpoint, this was very expensive, and it would have been massively more efficient to design it this way. According to the lawsuit, the point of the sale was tax-free retirement income. Death benefit for estate planning or income protection purposes was not mentioned. As a result, we can assume that the Bushes were using these policies for the sole purpose of driving accumulation and income. Extra death benefit was not the goal. Now, when you do the 5-pay design, you do need to increase the death benefit as opposed to a 7-pay design. So that's why they're bringing this up. And yet the policy was issued with a stonking $44.5 million death benefit. That would be a problem for any normal policy meant to be overfunded, but particularly for one with a $492 flat extra per thousand of face amount. The total cost of insurance, including the flat extra, tally to $2.26 million on Pax Life currently sold Horizon IUL, which is virtually identical to the design the PDX2 had and serves as a proxy for the original policy. Okay, so he's using the current product as a proxy to come up with these numbers. The problem with this is I actually don't think that it was a $44.5 million death benefit for what was issued. When I run the numbers today, with today's limits in place, we come up with about $44.5 million as the death benefit needed to be able to put that much money into a policy today. But back in 2020 and 2018, it would have been a lot more than that. So most likely, these numbers are even worse than what's being presented here from Bobby Samuelson. Without that flat extra, this flat extra, the extra risk it costs, when you have a massive death benefit, it's going to make a huge difference. Without the flat extra, the total cost of insurance would have been just $181,000. But because it had that flat extra, it was $2.26 million just in cost of insurance. Ouch, that hurts. Now, sometimes you just have to pay the extra to get the death benefit and the ability to put your money into a great product that should be downside protected and give you good ability to earn some growth. But the design is important so that the fees don't eat up too much of that cash value. Extra death benefit is always suboptimal in accumulation designs, but here it was catastrophic, sucking up over 30% of the paid premium in just the first 10 years. And it looks to me, because I think this number was higher, it looks to me like it would have been even a higher percentage of that. My guess is it was probably closer to 50%. Why did the agent set it up this way? We could maybe have given him the benefit of the doubt and said that it's a good thing for a NASCAR driver to have extra death benefit coverage while he's racing. We get that argument. That is, I'm sure, what the agent would argue in court. But nowhere does the desire for death benefit come up in the lawsuit. Instead, we know the game. More death benefit equals higher target premium. Target premium is what determines an agent's commission. Now remember, there is also the other argument that a 5-pay could grow and compound quicker and make up for the slightly less efficiency if it was an optimal design. But in this case, it's got to make up for a lot more inefficiencies. But that could be an argument for a 5-pay over the 7-pay as well. This says there is little justification for a death benefit this size other than increasing commission. It was well in excess of what was strictly needed to fit the premium flow into the policy for tax purposes. The agent could have stopped there, but he didn't. Rather than using commission-free annual renewable term coverage for a portion of the $44.5 million in death benefit, the agent decided to use fully commissionable basic coverage for the entire amount. And there's actually a lot of people, a lot of really big channels on YouTube selling insurance like this that do the exact same thing as far as designing without doing a blend of annual renewable term. Insurance companies have the flexibility. They give the agent the flexibility to blend in annual renewable term. Pacific Life sets the default coverage at a 50-50 split, which generally puts the commission to a level that is market competitive. Pacific Life's product allows for a much bigger split than that. You can actually do 5 times the base amount in annual renewable term coverage. So instead of it looking like a 50-50 split, it's actually a 16.66 to 83.33 split, which would put the commission a massive amount even lower than that. Now, this policy was purposely configured to pay more than double market competitive compensation with 100% base coverage design. And this is what a lot of agents do. This is the default design on most other carriers' policies. Most other carriers' policies don't do a 50-50 split. So from Pac Life's perspective, at least that's like the default setting. Most default settings is 100% base coverage design. And a new agent doesn't even get taught that they're able to blend in that stuff. But there are some carriers that allow a 10-to-1 blend. And we can really bring that commission down. Regardless of what the carrier allows, we here always advocate for reducing it to the lowest possible amount because that gives the client the best opportunity for growth and the best opportunity for these policies to succeed because we minimize the expenses in the policy, allowing more cash value to be available immediately to grow and compound. As discussed in his last article, there's no legitimate benefit to using basic over annual renewable term coverage. And I argue for that constantly on this channel every time we talk about policy design. It's a commission play, pure and simple, that transfers policy from the policyholder to the agent. 100% agree with this. On top of that, the agent issued the policy with an increasing death benefit in year 1 with a planned switch to level death benefit in year 2. He says the charitable rationale is that the agent was trying to increase the guideline premium and guideline single premium limits, but that could have easily been handled by just using CBAC. Now, this is not quite accurate. I know of no circumstance in a policy design that making a switch from year 1 to year 2 to a level death benefit gives you the actual benefits of starting with an increasing death benefit. By using an increasing death benefit, we generally do get 3 times as much guideline premium limit, meaning you can put in 3 times as much money for the same death benefit, as long as we're using that increasing death benefit. But the MEC test is a 7-year MEC test. You have to maintain that increasing death benefit for 7 years. Otherwise, if you make the switch, it's going to revert to whatever the MEC limit would allow with a level death benefit. So this makes no sense to me, why they would do this switch as planned in year 2. Now, they didn't actually make the switch. In the lawsuit, it says the planned switch never happened. So whatever justification that the agent made to the clients as to why this was needed in the first place, and I'm only guessing that it was just blowing smoke so that he could get this special design because you're about to find out why he did this design. And it had nothing to do with anything that benefits the client. But normally we start out with an increasing death benefit because it allows us to increase the amount of money we're putting in And you can't make a change until after year 7, otherwise it's going to create a mech. So essentially, this agent started with whatever the death benefit had to be, even if it was a level death benefit design. And it didn't matter if they made this switch or not. The real reason, it seems, was to further increase compensation. By issuing the policy with increasing death benefit rather than level, the target premium with 100% base coverage jumped from $550,910 to $1.494 million. It's probably not a coincidence that the target is just a hair off the planned premium of $1.5 million. You can imagine how this probably happened. Kyle and Samantha committed to $1.5 million, and then the agent worked the policy to get the compensation to match. By every indication, that's exactly what happened. I would agree, that is exactly what it looks like. Now this, as we're about to find out on the next slide, when making it an increasing death benefit, this is something unique to Pacific Life, that it increases target. In every other carrier's design, certainly all the ones that I do right now, there's no effect on target premium, whether you're using increasing or level death benefit. So this is an odd thing to have happened, and it's going to be addressed here in a second. The incredible part of this story is that because these policies were issued prior to AG 49A being enacted, in 2021, they still illustrate remarkably well. This policy illustrated a whopping $787,000 in annual income using participating index loans, of course, starting at age 51 and running to age 80. The IRR on both the income and illustrated residual cash value at age 95 is 6.09%, which is above the illustrated rate of 5.76%. It's easy to blame PDX and PDX2 for this fiasco, but Horizon 2 IUL, their new product, illustrates $626,000 of annual income with the exact same configuration. Now you got to remember, this is not actually going to be the exact same illustration because they would have required a higher death benefit in that older product because of the mech limit requirement changes that happened. So I'm not exactly sure if these numbers are all completely accurate because he's using the Horizon 2 and trying to use it to imitate the PDX, but interesting nonetheless that even despite this terrible design, the illustration actually makes the product work. But it does require getting above their illustrated rate of 5.76%. Now, the IRR in the illustration showed 6.09, and the reason that was above is probably because of the bonuses in there that were being added on top of the illustrated rate of 5.76%. This is the cumulative premium paid, and this is the actual account value during those first 10 years. Ouch. Now, that IRR they were talking about was at age 95. So 10 years into it, yeah, you don't have the cash value, and you've put in all of this premium. The fact that charges overwhelm credits even on the original illustration is an indication of the fragility of the original design. Money has to get into a policy in order for it to persist. That only happens two ways: interest crediting and premium payments. Strong policy performance might have saved the day, but the average policy interest crediting rate through February of 2024 was just 1.5%. How in the world is that possible? Because the first 3 years of the policy, the cash value was allocated to the fixed account, earning only 2.25% interest. Once the reallocation happened, the performance of indexed accounts was effectively zero. He has no words for this, and I don't either. Since 2020, the S&P rattled off really good returns. Allocating to the fixed account meant that Kyle Busch got virtually none of it. There were some really good return years in there, and the agent never had them allocated to an indexed account to actually get the growth from the index. This also speaks to an uneducated consumer because the actual client has the ability to go in and look at their policy and change the allocations every single year that they own this policy. So there was something that was not happening in here. And I'm not blaming the client for this. There are a lot of people that buy these products that just don't understand finances. They need to make sure that they're in touch with their agent each year. Do an annual policy review. Take a look at what index options you have, what you're allocated to, and reassess, is this what we actually want to be in? Now, in the actual lawsuit itself, the Bushes did reach out to their agent multiple times, and the agent assured them that the policy was performing as expected. So the The clients tried to do some of their due diligence, but they didn't actually just go into their online account and see that it wasn't actually performing. So I'm not sure where the breakdown was there, but in the lawsuit, they did interact with their agent, and the agent flat out lied to them about what was happening, that it was performing as illustrated when clearly it wasn't. And their funds never actually made it into an indexed account. Just wild. On top of that, the $1.5 million premium was billed semi-annually at $750,000, but was only paid annually, except for one July premium of $750,000. Now, I'm not sure where he got this. It doesn't specify this in the lawsuit. So maybe he got a chance to talk to somebody. In one of the letters, it does say that it was paid semi-annually, and they only included one letter in the lawsuit that mentions the second annual payment needed to be paid in order for the policy to perform as the original illustration showed. Now, that language in itself is a bit confusing, and if you look in the lawsuit, the Bushes actually made it sound like they thought if they made that payment, the policy would perform the way the original illustration performed. But what I hear when I hear that language, it basically means if you don't fund the policy the way it was originally illustrated, it's not going to perform. It can't perform the way it was originally illustrated because you're not funding it the same way. Now, the agent obviously neglected to tell them that it wasn't performing anyways because they didn't put it into the indexed account. All right. As a result, the total premium over the first 4 policy years was just $3.75 million. I'm not sure if that's actually the case because, like I said, you can't tell that from the illustration. But if he has some other information from somewhere, then maybe this is accurate. We just don't know. But the policy charges were $4.15 million over those first 4 years. Now, he says this is estimated, which tells me that he doesn't actually know how much was put in there. So I'm thinking that this is not accurate. So what happened to the policy? It lapsed. And so did the other PDX2 sold in 2020. And so did Samantha's 2018 PDX, despite the fact that all those premiums were paid and the policy performed at 6.1% through June of 2023. So the policy actually performed better than illustrated, but we had lapses because either they didn't put enough money into it, which is entirely possible. If they underfunded it as it was illustrated and it had those massive expenses, it will certainly lapse. But it could have happened anyways if they were in a fixed account earning 2.25% and the expenses were over 100% of the money that they were putting into it. Like the math doesn't math, right? This situation couldn't have occurred with any other carrier, at least not at this magnitude. Could the agent have sold more death benefit than was strictly necessary with another carrier? Of course. But would the target premium have been this high? Absolutely not. This agent could have sold any other carrier with the same $44.5 million increasing death benefit, and target would have been between $500,000 and $600,000. That's the case today. But at Pac Life, the agent could push the target all the way up to $1.5 million, and that is exactly, precisely, and unambiguously the cause of this situation. Not life insurance, not index universal life insurance, not even PDX. The problem is a compensation structure unique to Pacific Life that can create a situation like this. And this is where Pacific Life is going to run into a lot of problems with this lawsuit. Why would you give the ability to make that happen? Why? It just doesn't make sense. In what world does an agent need to make $1.5 million for a commission on one policy? Even a policy that's that large just doesn't make sense. The agent could just as easily have made a different choice to favor Kyle and Samantha Busch in the policy design. If the agent had sold the same cumulative premium, but spread it over 8 years with the minimum amount of death benefit, which at the time was around $32 million under the old 4% 7702 regime. Yeah, see, spreading it out over 8 years, you would have needed $32 million. So by going over 5 years, you would have needed quite a bit more. That still doesn't seem high enough. He could have used a 50-50 basic ART coverage blend with a level death benefit using CVAT. The commission would have been right around $200,000. That's a far cry from the $1.5 million. The total coverage charges over the first 10 years would have dropped from $3.6 million to just $567,000. Now, I actually ran these numbers with a $44 million death benefit on one of the policies that I do today. With that particular product, it allows us to do a 10-to-1 design. And the target premium comes all the way down into the $50,000 range, not even $200,000. So you could have a client that can put in $2 million a year into a policy, and we can get that target premium to right around $50,000. These things can be really great with that type of design. Just incredible. And the insurance charges will be very, very low over those 10 years as well, even less than this 567. So there is the ability to get very, very good designs in here. And this is the complete exact 100% opposite of that. Total policy charges would have dropped from 88% of the total premium in the as-sold design to just 33%, the vast majority of which is related to the flat extra. Oh yeah, with the flat extra, it probably would be up around this high. Now, flat extra does affect target premium. So target premium would be a little higher in the one that I did as well. And target premium goes up to a little over $80,000 when you add in the flat extra charges. Moving on, that policy configuration would have worked out perfectly well. The cash value would go up every year in the base illustration scenario. There would have been no massive loss on the ledger and no lapse, even if the premiums weren't fully paid. In other words, this situation would have been entirely avoided by a quality policy design built in favor of the client, not the agent. The agent made a choice. It was a terrible one, but it was his choice. Yes, most of the problems that we will see in a high cash value life insurance design, even in low cash value designs, if somebody's not funding at very high levels, is because of policy design. The policies should always be designed for the client's benefit, not the agent. For that reason, it strikes at the heart of what Pacific Life has been doing with adjustable compensation for decades. It is a massive threat. You can imagine a scenario where every 100% basic coverage policy gets looped into a class action lawsuit. Absolutely. But what about 90% basic or 80% basic or 20% basic? Some carriers don't even allow any type of a blend. So basically they would avoid that altogether. But every policy they sell has massive charges in it that you just don't get if you go with the different carrier's policy that allows you to do the blended designs that reduce the base. He says that's where this case gets dangerous. It cracks open a whole slew of issues about how agents get paid and how commissions are recaptured in policy charges for all life insurers, not just Pac Life. There has always been talk of a case that would challenge the underpinnings of commissions in this industry. It was only a matter of time. This may very well be the one. Yeah, I agree. I have a major problem with the commission levels that get paid out on these policies. We structure every design to minimize that agent commission, and these can be amazing financial tools to help diversify a portfolio, but give a different exposure with downside protection. They can be amazing, but there are so many bad designed policies that get sold. Not as bad as this one, but there are obviously some policies that get sold with this bad design because Pacific Life allows it to happen, allegedly. It looks like the Bushes have a really good case. So that was the details. What went wrong? Everything the agent did went wrong. Pacific Life supporting that agent with the design and some of the language that they use is one of the things that went wrong. The ability to be able to tweak it to triple the target premium and triple that commission. Wow, that's how they got scammed. So how to avoid this when buying life insurance for yourself? If you're looking to buy life insurance, find a good agent. Make sure that they're doing optimal designs. And you only know if they're giving you an optimal design if you do your proper education. YouTube is an excellent place. My videos are an excellent place to find out what's possible from a design and what should happen. You can meet with me, use the link right over there, and I can give you a second opinion. If you have an illustration from an agent that you're already working with, maybe you're already into the underwriting process. As long as you haven't sent in the money and started the actual policy, signed for the policy delivery, and you're past the free look period, you can get it changed. You can fix it. A bad design, you can get it fixed. Schedule a meeting with me. I do this all the time. You don't even have to do a paid consultation. There's free ones available. I will help you out. I hate seeing bad designs like this. Whether you're putting $100 a month into a policy or $1 million a year, it doesn't matter. I want to see you get the best designed policy because these things can be amazing tools, but they have to be designed to fit what you're trying to do. Also, we're going to have a conversation and make sure, is that the right product for what you're trying to do? Now, I'm not an IUL hater. I actually like it a lot, and I own quite a few IULs myself. But that doesn't mean I'm an advocate of every IUL out there or every design. Far from it. There's actually only a very, very small portion of products out there that I would personally put my money into. And even those products can be designed poorly. That doesn't mean that they won't work. A poorly designed IUL can work, but the likelihood of it is a lot lower, and the efficiency is a lot lower. If you can't tell, I'm a massive advocate for the best policy designs for you, the client. Use my expertise. I will help you out. I will make sure that you get a good design. If you want to work with me, I would love to work with you, but you don't have to. The people that meet with me, they can just come to me. You get the good design, and you can work with whatever agent you prefer to work with. And I do this because I have a good reach here on YouTube, and I end up working with a lot of clients that decide that maybe that agent that didn't give me the good design or just doesn't know enough, maybe that's not going to be the best agent for me. And they choose to use me instead, which I appreciate. But because enough of them do that, even though I'm designing policies for the lowest possible commission, I make enough money that I don't need to charge people to do reviews. I can do a review. It doesn't take me very long. It only takes a couple of minutes to look at a policy and see what was wrong with it because I'm familiar with the details. I know this stuff. I make it my duty to understand how these things work and what an optimized design is going to look like. So it doesn't take very much of my time. Please get in touch with me if you have any concerns about the policy you're looking to get. If you're already in a policy, we can still have that conversation. What's the best thing to do if you're already in a policy that might be badly designed? Like I said, it's not the end of the world. Policy that's poorly designed can be managed to make it work in some cases. Other cases, it might be best to just get rid of it. Stop throwing good money after bad. But there's a lot of cases that you just tweak it to make it work for what you're trying to do. I appreciate it. If you made it this far into the video, please hit that like button, subscribe if you haven't subscribed, and in the comment section, let me know what you think about this lawsuit. Is there something about it that I didn't cover that you would like to hear about, or just any outstanding questions that you might have that I didn't address yet? I have an IUL playlist as well, where you can check out and learn almost everything you need to know about policy designs and what's available out there. So be sure to check out that playlist on my channel, or take a look at these other videos that are going to pop up as suggestions here, and we'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.